What is the most important mathematical idea in stock trading? In the world of stock trading, mathematical principles are more than just supporting tools. They're the bedrock of strategic decision-making, turning what might seem like speculation into a calculated approach. However, among the many mathematical concepts applied in trading, such as statistics, calculus, and linear algebra, one stands above the rest in importance: probability and risk assessment. These principles help traders navigate the unpredictable waters of the stock market, turning unknowns into manageable probabilities and risks. For a trader, probability is indispensable because it offers a structured way to evaluate different market outcomes. At its essence, probability recognizes that while no one can foresee market movements with certainty, there's a quantifiable likelihood for every potential outcome. This perspective shifts trading from guesswork to science, where traders estimate chances and prepare accordingly. Probability-based analysis enables traders to move beyond emotional impulses and base their actions on probable scenarios rather than gut feelings. For instance, if a trader is analyzing whether to buy shares of a tech company, they might predict, based on market analysis and historical performance, a 70% probability of a 10% price increase within 3 months. This isn't a guarantee of success, but it offers a rational basis for action, supported by historical data and research. Probability also serves as a foundation for risk management, another vital element of successful trading. Without understanding and managing risk, even the most promising trades can end in substantial losses. Risk management helps traders limit potential downsides and safeguard their capital while still allowing room for growth. Stop-loss orders, for example, are tools that enable traders to exit a position automatically when the stock price reaches a predetermined level, thus reducing the chance of large losses. The placement of these orders is often determined by assessing the probability of adverse price movement. Let's say a trader buys a stock at $100 per share and sets a stop-loss at $90. Based on their probability analysis, they calculate a 20% chance the stock might fall below $90. This 20% probability represents an acceptable level of risk, allowing them to hold onto the stock with a level of confidence, knowing there's a defined limit to potential losses. Expected value, EV, is another core mathematical concept that helps traders calculate the average outcome of trades over time. EV represents the anticipated profitability of a trading strategy, accounting for both potential wins and losses. The formula for expected value is straightforward but powerful. EV equals bracket open probability of win times value of win bracket close minus bracket open probability of loss times value of loss bracket close. This calculation guides traders to look at the bigger picture, beyond the success or failure of individual trades. A trader evaluating 2 trades, for example, might find that the first trade has a 70% chance of a $200 gain and a 30% chance of a $100 loss, while the second trade has a 50% chance of a $400 gain and a 50% chance of a $300 loss. On the surface, the second trade appears more attractive because of the higher potential gain, but an EV calculation shows that the first trade is actually more favorable in the long term. By quantifying the potential gains and losses of different trades, EV helps traders make choices aligned with their long-term objectives and risk tolerance. Volatility, a measure of how drastically a stock's price fluctuates, is another concept tightly linked to probability in trading. Higher volatility often suggests larger potential gains but also increases the likelihood of significant losses. Volatile markets require traders to adjust their strategies, often relying on probability to gauge the likelihood of extreme price swings and tailor their responses accordingly. For example, in options trading, a trader might adopt a straddle strategy on a volatile stock, buying both a call and a put option to benefit from major price movements in either direction. By understanding the probability of large price swings, the trader can structure trades that make volatility work in their favor, rather than against them. In this way, probability helps traders harness volatility rather than merely reacting to it. The role of probability extends to position sizing and portfolio diversification as well. Position sizing involves determining how much of their capital a trader should allocate to any single trade. Here, probability and expected value calculations are crucial in managing risk and ensuring that no single trade outcome can cause irreparable damage to a trader's portfolio. For instance, let's assume a trader has a total capital of $50,000 and follows a rule not to risk more than 2% on any one trade, meaning a maximum risk of $1,000. By adhering to this position sizing rule, the trader spreads risk across multiple trades, limiting losses in any single trade while keeping ample capital available for future opportunities. Diversification, another essential risk management strategy, uses probability to help traders spread investments across different assets or sectors. By holding stocks in a variety of industries, such as technology, healthcare, and utilities, a trader can reduce the likelihood of simultaneous losses across their portfolio. This approach not only minimizes the impact of sector-specific downturns but also increases the chance of gains from unrelated sectors moving independently. With probability, traders can quantify the likelihood of correlated losses and choose diversified assets that maintain stability even when one sector experiences a downturn. In recent years, trading has increasingly moved toward algorithmic and data-driven models that heavily rely on probability and statistical analysis. Algorithmic trading uses models based on historical data to predict and react to market movements with precision, often minimizing human error and bias. High-frequency trading, HFT, a subset of algorithmic trading, executes large numbers of trades at high speeds, often capitalizing on small market inefficiencies. These algorithms use probability-based patterns, such as mean reversion, where prices tend to return to a historical average level, to predict probable price changes. For example, an algorithm might detect a temporary dip in a stock price below its moving average and execute a buy order, assuming a high probability of mean reversion. This systematic, data-driven approach helps traders make decisions based on probability rather than emotion, often leading to more consistent and profitable outcomes. Ultimately, probability remains the backbone of effective trading. By offering a framework for estimating outcomes, it helps traders minimize risk, make strategic decisions, and manage portfolios with a focus on long-term growth. Although probability doesn't provide a guarantee, it empowers traders to approach the stock market with a balanced perspective, preparing them for a range of possible scenarios rather than banking on one specific outcome. In this way, probability transforms trading into a discipline, where risk and reward are calculated parts of a broader strategy rather than mere speculation. Whether through evaluating expected value, setting stop losses, or optimizing position sizes, probability enables traders to navigate the inherently uncertain landscape of the stock market with greater confidence and control.